Kia ora, and welcome to the Cotality Property Market Update for Hui Tanguru, February 2026. Property values across Aotearoa continue to track sideways to start the year, with a negligible 0.1% fall in January. We finished 2025 down 1.0% for the year. We are currently sitting 17.5% below the peak of early 2022. However, the national measure hides a regional split. Tamaki Makaurau Auckland and Te Whanganui Atara Wellington both experienced minor declines over the month of 0.3% and 0.1% respectively. Both of our largest cities are now essentially stuck, sitting more than 23% below their previous market peaks. In contrast, the regional centres, particularly down south, are showing real resilience. Waihopai and Vikago values are up 1.6% over the past 3 months, and with a median value of $507,000, the city is actually hitting new record highs. It's a tale of two islands right now. The north is dealing with supply overhang and job uncertainty, while the south is benefiting from better affordability and a steady primary sector. Sales transactions for 2025 totaled just under 91,000, which was a healthy 9% lift on 2024. However, 2026 has kicked off in a sluggish fashion. January sales volumes landed at around 4,300, a 10% drop on January last year. This bucked the broader trend of increasing activity we've seen for the last 2 years. Although there's a possibility it's simply a timing issue, with some activity brought forward into December when volumes were up over 23%, taking the year-on-year comparison to 6.1% up over the last 3 months. First home buyers closed out 2025 with a record 28.3% share of the market for the final quarter. They are benefiting from lower competition and continue to take advantage of low deposit lending, with roughly half still using this allowance to get into the market. Mortgaged investors are continuing their comeback, rising to 25% of sales in Q4. Lower interest rates, which means smaller mortgage top-ups, and the return of interest deductibility, as well as the shortening of the bright line test, has clearly brought mum and dad investors back to their long-term average. The missing link is the owner-occupier. Movers have fallen to just 25.3%, their lowest share since the global financial crisis more than 15 years ago. These homeowners are waiting for surer signs of economic recovery before committing to a move. Reading the economic data right now is like trying to navigate in fog. The Q4 CPI inflation result of 3.1% was slightly higher than expected. And while it's not a reason for panic, the Reserve Bank focuses on the medium term, it has killed off hopes for any further rate cuts, with the question now being about when the next rate change will be upwards. Some market analysts have brought forward expectations for an OCR hike as early as September 2026. But this feels a bit over the top, given the current weakness in the retail sector and the jobs market. There's still spare capacity in the economy too, which should dampen inflation. Retail data is disappointing. Electronic card spending fell 1.1% in January, showing that even with slightly lower rates, households aren't rushing back to the checkout. The unemployment rate rose to 5.4% in Q4. It looks bad as a headline and isn't great, but it was driven by a higher 70.5% participation rate. More people are looking for work, rather than the economy just shedding jobs. December saw a massive refinancing wave. We saw $14.1 billion in new residential lending, the highest since records began in 2013, driven largely by people switching banks to capture a tidy cashback of up to 1.5%. There have also been strong signs of more people starting to fix their loans for longer terms again too. We're also awaiting the impact of the debt-to-income and loan-to-value ratio changes. December's extraordinary lending data muddied the waters of high DTI and high LVR borrowing, with so much lending being done, which means we need the data to settle down a bit before assessing trends. The DTIs aren't binding yet because values are flat and a cautious attitude still prevails, but they are now a permanent part of the reporting landscape, acting as a structural lid on how much debt the market can take on in the future. We cannot ignore the November 7 general election either. Traditionally, elections slow down transactions as people wait for policy certainty. If the polls suggest a continuation of the incumbent government, expect less disruption. However, if a potential switch gains momentum, especially one involving a comprehensive capital gains tax, we could actually see a preemptive rush. Buyers and investors might bring purchases forward to lock in settings before a new regime takes over. The year is set up for some growth in values, but each new economic release seems to push the real recovery further toward the end of the year. The settings for a lift are there, affordability has improved, and mortgage rates have plateaued. But while labour market uncertainty persists, any growth in demand will be gradual. With supply remaining plentiful, there is no reason for buyer desperation. For now, the market is treading water, waiting for yet more data and, importantly, the Reserve Bank's read on it. Stay up to date and download our latest reports at cotality.com/NZ. Follow Cotality NZ on social and subscribe to the New Zealand Property Market Podcast on your preferred platform. Mā te wā!